Hi, it's Eric Nuttall of the Ninepoint Energy Strategies. Welcome to 2025. This is our first weekly update of the year. Happy New Year to all. We remain bullish in the outlook for energy stocks as we enter into the year, as we look at oil demand, which continues to exceed very bearish expectations. We have global oil inventories as of now at their lowest levels in recorded history, meaning as far as back as satellite imagery goes to 2017. And importantly, and I think this is going to be a key theme for 2025, the ongoing disappointment of U.S. shale production growth as data continues to come out to reaffirm that view. And so 2025 remains a year of digestion. This will be the last year of meaningful supply growth from non-OPEC producers forever. And perhaps the twilight of U.S. shale, we think, is going to become much more obvious to the masses, which will lead to a bullish catalyst for oil and energy investors. Earlier this week, we also had another what we think would be a bullish catalyst, and that is the resignation of Canadian Prime Minister Justin Trudeau. We view the likelihood of an election around April time, with most polls showing the highly likely outcome being a new Prime Minister, Pierre Poilievre. We've met with Mr. Poilievre in the past. We view his policies to be incredibly more pro-energy. I don't think it's a stretch to say over the past 9.4 years, the Canadian energy sector has had to deal with a series of antagonistic actions, from the cancellation of Northern Gateway to comments that we have to phase out the oil sands, Bill C-69, which effectively makes it impossible to ever build another pipeline, Bill C-59, which threatened oil companies with multi-billion-dollar fines if they made claims such as, Canadian LNG is a good solution to displace coal from China, unless you could, back it up to internationally held standards, and those standards don't exist. So companies would be, threatened with literally multi-billion-dollar fines. So it's a long, long list. The importance of a new government is huge, because when you look at the strategic advantage of Canadian oil stocks, we're blessed with an abundance of reserves, literally measured in several decades. Some companies having 50 years of stay-flat inventory. We have incremental egress, TMX coming online with it successfully compressed the differential for Canadian oil. We have LNG Canada for natural gas coming online in the next several months. We have incredibly strong balance sheets, owing to the benefit of deleveraging over the past couple of years. We have companies that have pledged low to no growth, maximum free cash flow, using that for share buyback. So everything that a global investor has wanted or would want in the energy stock, we have it in Canada. That last final box would be, a government that is supportive of a sector, especially in Canada, where it's roughly 15% direct indirect of the Canadian economy. And so we see the elimination of a political risk discount becoming a reality in the coming future. We also have a Trump presidency in the next couple of weeks, roughly 11 days from now. We look to having some semblance of certainty on tariffs. It's an unknown fact that the United States actually has a trade surplus with Canada of roughly $58 billion if you exclude energy. And when you consider energy, primarily oil and natural gas, Canada is about 60% of U.S. net imports. And frankly, it's a product that there's no substitution. It's irreplaceable. We have Midwestern refineries connected via pipeline to get Canadian heavy oil. U.S. refineries are geared to process heavy, not light, which is predominantly what the United States produces. And substitutions of Canadian heavy oil come from Venezuela. So it's hard pressed to see a Trump presidency favoring Venezuelan crude over Canadian crude. So if tariffs go ahead, it will be a direct pass-through to the U.S. consumer in the most visible measurement of their cost of living, which is the gasoline price as they pull up to the pump on a weekly basis. And so we look forward to having some semblance of certainty. Broadly speaking, the Canadian energy sector at large, sentiment remains somewhat challenged. 2024, despite pretty decent performance, we saw global energy ETFs experience their largest outflows going back to at least 2016. We were pretty vocal saying that we were seeing firsthand, we had a firsthand row to witness the very vicious tax loss selling that was occurring in December. We've had some of our key names rally as much as 25% from the lows in mid-December, so it kind of corroborates that view. We've met with the CEOs of most of our larger holdings over the past 2 days in Toronto. I'll be in Calgary next week at another great conference meeting with more CEOs. And we're really, really encouraged by the tone of those meetings, by the messaging, the commitment to low to no growth, maximum free cash flow, using that free cash flow for share buybacks. Our view is oil is going to be in a rough trading range of $70 to $80 this year. We think gas will trade roughly NYMEX about $3.50. And in that vein, we have companies that will be buying back 10, 11, 12% of their shares this year. And again, as a reminder, as we look to 2026 and beyond, as the rate of growth of oil supply begins to meaningfully decelerate for non-OPEC producers, meaning we go from roughly consensus now is 1.5 million barrels per day of non-OPEC supply growth. We think that is vastly too high, but let's just run with that. That will start to fall by half and then half again in 2026, 2027, meaning there is a imminent and growing call on OPEC plus supply, leading to the normalization of OPEC spare capacity. And that is, I think, the largest reason why the relationship between global inventories and price broke down last year. This belief that, well, yes, while global inventories are low, i.e. the lowest in recorded history, OPEC's just going to bring on supply, especially when we had to listen to the false narrative that OPEC plus cohesion was faltering and they were worried about losing market share to U.S. shale. We know that was factually incorrect. That was one of our key calls that was proven to be correct. And so we believe we're in a multi-year bull market for oil as the twilight of U.S. shale becomes more and more obvious to the masses, as the inability to sufficiently invest, the maturity of most key producing basins in the world, leading to that strong deceleration in supply growth from non-OPEC, the ability of Saudi, UAE, and others to bring on that 4 million barrels per day of spare capacity, and our belief that the demand for oil will grow much longer and much stronger than consensus believes. And so we remain bullish on the outlook for energy equities in 2025. We look forward to an update next week. We'll be meeting with many more executives and we'll bring you some of our key insights next week from those meetings.